I'm Charlotte McLeod with investingnews.com, and here today with me is Joe Cavatoni, Senior Market Strategist Americas at the World Gold Council. Thank you so much for being here. Great to have you.
Great to be back, Charlotte.
Really good to be catching up with you. And where I thought I would begin, we are actually both just returning from the Rules Symposium all the way down in Florida. And we didn't get a chance to talk there. We'll make up for it now. But I wanted to begin by asking if you had any key takeaways that you would share either on gold or maybe on investor sentiment.
So I think that's a great place to start. I would probably start with three key things that I take away from the symposium. Number one, the attendance and the content and the audience engagement was better than it's ever been, at least in the years that I've been attending it. And I think that actually that speaks volumes about the current state of the industry and actually the natural resources space in general. So I think it's very positive. Second, I think the engagement in terms of mining, investors, all those that are in the production line of precious metals or natural resources, there's full on lots of interesting opportunities, and people should actually pay close attention to what's going on. And then, the right questions are being asked. What continues to be the outlook for gold? What might take a little bit of the momentum away from gold right now? How should we be seeing it? And what are the big key fundamentals keeping that market in play? And I think that those were all really key takeaways. And that's where the discussions were fun and interesting for me. And again, it's not too hard to get down to Boca. It was a little hot, but it's also pretty hot in New York these days. So it's okay to be hot at the beach.
Well, thank you for sharing. I also had a great time at the event, and I think it's really good to recap what you saw there. The other thing I wanted to go into with you today is we're a little bit over the halfway point of the year, but I think it's a good time to reflect back on the first 6 months of 2025. So obviously it was a record-setting time for the gold price, but there's a lot of nuance. So if you were to sum up H1 for gold, how would you put it?
Well, I think risk and uncertainty is the phrase that I'd use to most absolutely represent what's going on in the world. As a consequence, risk and uncertainty, market risk in particular, is a key strategic driver for the gold price and performance. So I think that that's it. We have had more uncertainty, more news cycles that have been extravagant and unpredictable, that most people are really managing their portfolios as best as they can, but also trying to manage global risk in a world where systemic events and fundamentals are meeting up and saying there's a lot on the horizon that keeps us concerned about how risk assets will perform. So I think that that's really been driving the gold market. I think that not only the systemic moments or the big pushes when you hear things around tariffs or other issues, and then underlying all of that, what's the fate of the economies around the globe and the dollar in particular?
Absolutely. I think we're all feeling that right now. And again, looking back at the first half of the year, so we're waiting for the latest gold demand trends report, but the World Gold Council did recently release its latest report on gold ETF flows. And I noticed one interesting stat, which is that physically backed gold ETFs had their best half-year performance since the first half of 2020. So we all, I'm sure, can remember what was going on in the first half of 2020. So I'm wondering what that can tell us about global circumstances right now, probably relating back to some of the issues you're just talking about.
I think that that's it. I think what really is playing out with the investment community now, for the first half of 2024, we talked about that being driven by the Eastern investor. That was a big surprise to the upside for us to see the development of financial products, consumption of gold, portfolio allocations in that part of the world. Second half of 2024, followed by the Western investor. And interestingly enough, that slowed a little bit in the second half when rate cuts started to slow in the U.S., the likelihood of rate cuts. But where we have been in 2025, again, market risk and uncertainty, tariffs, what is it going to mean for the economy? How's trade going to look? All of that has brought the Western investor and the Eastern investor back to the table, and strong performance in particular out of the North American ETF suite, which has seen just record flows. Now, standout in Asia has been the Chinese market, where the flows have just been exceptionally large. Now, that's slowed a little bit in the second quarter of the year, but the key thing here is that all of these conditions are lining up for what we're seeing, which is a holding of the positions after we've seen the growth. So you're not seeing people unwinding that investment horizon. And I think that that's actually a telling sign, because they might feel a little more comfortable about risk, but what they're ultimately saying is they still see it on the horizon as being a big challenge. And ultimately, that role that gold plays, we think people have been under allocated in the Western markets in particular. And I think we're starting to see that pick up a lot more and allocations coming in. Now, remember, the ETFs are only a small component. And when we do get our GDT report for second quarter, we'll give some more insight on the OTC flows, which I think will help out as well.
Right. I'm sure that will really help add color to the ETF data. But just looking a little bit more at the ETF, since that's what we have right now, it seems important that we do have the West and the East at least starting to move together at this point. Is there anything more you would add on that note?
So I'm actually still perplexed over the fact that Europe has been a less active market in the transparent gold market. So when it comes to the ETFs in particular, my read of the conditions of Europe might have been that we would have seen a larger allocation to gold out of the European arena. But I think right now the risk markets in Europe have seemed exceptionally strong and opportunistic for investors. So I think that they're gravitating to those risks and grabbing to the risk assets, in particular the undervalued equity markets and the opportunities that could be there relative to other markets, the U.S. market or other markets in Asia. And so I think while they're still continuing to see that risk market appeal in Europe, there will be a moment when they need to come back around. Again, though, the North American market, the U.S. in particular, very strong, China very strong, India right behind it. So you're going to keep seeing that. But I think what we're looking at is when Europe's going to come online.
And talking a little bit more about the US, I'm seeing a lot of questions, and at the World Symposium also this came up a lot. What is the Fed's path forward in 2025, especially now that we have Powell facing criticism on a pretty continuous basis from Trump about how he would like to see him cut interest rates? Any thoughts there?
Yeah, I think we're waiting, and actually that'll be a big fundamental shift in what most investors will look for to be that kind of big driver fundamentally for what's going on with the gold market. Right now you still have a large portion of cash sitting in money market funds, and actually those are very appealing at current rates. But as rates get cut, that'll be less appealing. And I think that those dollars in play might find their way to the gold market. So I think whether Powell is going to finish his full term, or there are rumors around him leaving early, or whatever the case may be, I think ignoring all of those factors, I think the key thing will be listening to what the Fed as an aggregate of governors is saying around where they see the rate market and how they see things to be actually most appropriately handled. So I think keep close watch on that. And that'll play out over the course of the next 3 to 6 months. And I think that you've got ranges from no cuts to 3 cuts based on what the banking community is telling us on the research side. So we'll know when we know. And I think right now, the Fed's intent is to find 1 or 2 cuts between now and the end of the year. And I think that they'll stay strong into that message. That'll be an appealing environment for gold.
Right. And of course, we've seen Powell make the point that they would have cut if we didn't have all of this tariff uncertainty around. And that really seemed to spike up again last week with all these different deals being announced and things like that. So the tariff situation, do you see that escalating or calming down as we head into the second half of the year?
I think the key thing that people need to appreciate about the tariffs, the motivation of what the tariffs are trying to drive, is it's not going to stop until the goal is achieved. So with the extension of the deadline, 90 days, 90 deals, that seems very aggressive. But quite candidly, when the market started to brush off the idea of an extension, maybe thinking there was no teeth to it, I think that the administration corrected that view. This is a serious topic. This is a serious discussion. Negotiations need to take place. Trade is key. Revenue is key. And I think that the administration is going to stay on it, whether it's a July end of July date or an August date. It's real. And I think people should not overreact to the noise, and they should actually try and do their best to understand that negotiations need to take place. So whether it moves again in terms of a deadline or not, we'll have to come and see. But more important, take it seriously, because I think the administration is telling us it's very serious.
I agree. I certainly think we can see that coming through. So we've gone over a couple of important gold price drivers to be watching into the end of 2025. Anything else that you would pull out as people are looking to cut through the noise here?
Yeah, I think actually putting a more fine point on it with respect to tariffs, in principle, the majority of the gold market is exempt from tariffs. So I think that's why we're seeing less of a price move on gold when you actually hear things moving in the gold market, or sorry, things moving in the markets around tariffs. Copper moved, silver's moving. These are things that are actually moving in response to the risk of tariffs. But in the case of gold, I think you'll find that the principal wholesale market's exempt from it. There are areas where there's still question around how those types of golds, the smaller denominations, might be treated with tariffs. But I think for the most part, I think people are actually feeling pretty confident that gold's not the target. Other minerals, other metals, other vital items to national security and electrical developments. Those are kind of things that are in the mind of the administration. But again, we're going to see the impact of tariff when the economic conditions start to weigh in post the trade negotiations. So as a monetary metal, we'll be looking more likely to see people gravitating to gold. If they are worried about a weakening dollar or a strengthening dollar, they might be holding back going to gold at that point.
Right. That makes a lot of sense to me, and good to remember gold in relation to the tariffs and what may be happening there. Going back to, again, topics at the World Symposium, of course, the U.S. economy was part of a lot of discussions, and there's some very concerning outlooks there. I'm wondering, what do you see coming? I've heard about recession, maybe stagflation, something worse. What are you thinking when it comes to the U.S. economy?
Well, I think we're basically expecting a general slowdown in the economy, and I think that effectively, you've got 3 or 4 key conditions that are actually existing. Higher prices, potential for job growth, but it's slowing. Ultimately, you've got an environment that is basically a debt spending environment. We've got a new bill that just passed through the U.S. administration, and spending is going to continue to increase. So overall, the administration is looking at ways to stimulate growth, stimulate jobs, and that actually takes a bit of time versus the very prompt timeline that we're dealing with, the debt burden. So I think that there is a window. There are windows for development to take place, but it's tricky. It's very, very complicated. Some of the ideas around growth are actually infrastructure related, and they take time to come online. So I think right now we're getting a good sense that whether or not the U.S. economy lands comfortably and safe or drifts into stagflation, or even for that matter, a recessionary environment, what is causing most of the interest in gold right now is whether or not the U.S. dollar remains strong, whether or not dollar assets perform, and looking out beyond even 25, 26, 27, out to 2030, when you have big headlines coming with Social Security bills like that are actually going to be very costly to the U.S. government. How are they going to get paid? So these are the factors that are at play. And I think that's what's keeping what we haven't talked about, central banks very much interested in diversification away from other reserve assets like dollars and dollar-based assets, and looking at gold quite aggressively. And I think that we're expecting the economy to be struggling a bit, but we'll see how it plays out when we see more over the next couple of weeks of news.
That makes a lot of sense. So we'll keep tabs on that, and I'm sure we'll talk about it again in the future. I think that gives us a nice idea of what's happening in the West. I did want to throw in one more question on Eastern trends, because you had told us in a previous conversation earlier this year to keep an eye on gold buying from the Chinese insurance companies. So there are a group of them earlier that got permission to essentially invest in gold. And I'm wondering if there are any developments there since then that you would note.
So there was the pilot program that has been announced, and I think 4 of the organizations had publicly been disclosed as having their overall agreements with the Shanghai Gold Exchange approved. So we've seen activity in the physical market. The premium levels have come down a bit. So that tells us that people are very active, but still maybe not as active as they were earlier in the year. So I think it's been good and positive We'll know more with our GDP numbers for second quarter. But right now, I think the case is still very much top of mind across the board in China. So more to come is what I would say to you, Charlotte. And getting the information out of China does take some time. But I think right now, what we do see are strong retail flows, premium levels cooling a little bit, telling us that there's probably a little bit of a slowdown in the pace with which things were buying, where investors are buying. And actually, we'll keep very close tabs on how things continue to develop with respect to import data around the gold market as well.
All right. So another reason for us to connect after the gold demand trends report. We'll keep an eye on that and hopefully get some more information later. I think if we look at all the factors we've been discussing, people are wondering now at the halfway mark of the year, they've seen such an impressive performance from gold in H1, and they're looking forward and wondering, okay, how does this play out in the second half of the year? Do we need to see some consolidation like we're seeing right now, or are we going to go higher? And I know you don't do price predictions, but is there anything you can share on that subject?
Well, I think the key thing that I'd probably start off with, and it's again focusing on central banks. The recent report we released with our central bank survey has given us a very good indication that most of the 73 respondents, which is the most we've ever had, are still signaling that they have a very significant interest in gold and a high probability that they're going to continue to allocate to gold. I think what we're dealing with right now is that pace with which they're actually picking it up. Now, we've had record or near record years for the last 3. We've had a 15-year trend of this purchasing from central banks. We might start to see them ebb and flow in terms of the speed with which they continue to pick up gold. First quarter was very strong. Let's see where they come in second quarter. But if they slow down, I wouldn't say it's a terrible signal for us. What I think it might be is actually absorbing this higher price level and actually looking more opportunistically about when to get involved. But at this point, we still have that very comfortable signal from the central banking community that moving away from dollars, moving away from dollar-based assets, moving away from the euro are all vital, and they're going to continue to stay at the table looking at diversification, with gold being the key asset that they're adding to their portfolios. But when it also comes to the investment community, I think there's still too much out there short term for us to see the real push forward to say, let's see gold increasing in terms of allocations. We're having more conversations than we've ever had. But people are still trying to get a flavor for what's going to play out with the dollar, where those rates are going to go. I think we keep a close watch on what we talked about a little bit earlier, which is rate cuts. I think the Western market's looking for that. Once they see that signal, the appeal to gold will be a lot higher. But right now, we're starting to see people understand the asset and realize that there's benefit of having it in the diversification in their portfolio. You know, you've had 14 different moments that we track around kind of drawdowns in portfolios, which we still continue to have these. And it's each and every one of those, gold performs exceptionally well. And the 6 months subsequent to that, it performs well, even better than people would expect in terms of the return profile that you get versus risk assets after a drawdown.
Right. I think it's definitely a learning process for people. So it's playing out. And I think you answered what I was going to ask you, which was, what could prompt the next leg higher for gold? Is there anything else you would add there?
Well, I think the constant risk of a systemic event constantly on the radar for us, and whether it's a flare up in terms of a conflict, whether it's the issue of trade-related activities that might cause people to flock more to the safe haven nature of gold. Those are always on our mind. But more importantly, I think we're still looking at fundamentals to see what is the real big signal that we can see from economies and where would gold fit the portfolio. Recently, we've seen data that has said that the gold asset in reserves has surpassed that of the euro. So central banks have more gold than they have euro in their portfolio. I think that's going to continue to be a big theme for us. But I also think one thing that is interesting is, where does the consumer end up in this whole thing? We've been talking a lot about investors buying gold, and we've been talking about central banks buying gold. Bar and coin demand in the Western market is still very thin and actually somewhat lighter than we would maybe expect, considering risk and uncertainty. Same in the Western markets in Europe as well as the US. But I'd say to you that in the East, it's been still holding up, but I'd like to see where that ends up. Because if they start to back away more, that might put a little more price downward pressure on gold. And I'd also say to you that we really don't have a view on how things are going to develop in the jewelry space. The jewelry space right now is still very much consumer driven. And actually, those data numbers have been down first quarter, down last year. It's not really the time and an environment for people to continue to pick up jewelry. So we're keeping a close watch on that. But for a breakout, I think what we need is some clarity around particularly the U.S. economy. That's what we need to get a flavor for.
That makes total sense to me. So thank you for going into that. And I will let you go. I think we'll have lots to talk about in our next conversation as well. But before I do, any final thoughts that you would leave investors with right now?
I think the key thing is, again, there's so much momentum and there's so much opportunity that people are moving quickly in the market. And a lot of people are getting hung up on the price right now. And I think the fact that the price is holding up, and actually that's a signal that people should understand is a good, comfortable thing for us, because we've hit record levels in the first half of the year. And we're actually holding quite firmly around 3,300. And while we're not calling the price, what we are saying is understand what the fundamentals are. Underneath all of that is market risk and uncertainty that is keeping investment and holdings in gold firm at this stage. You need to see a big shift in that, a real much better outlook for the economies for people to say, I don't need the diversification right now. And I think, it's hard for us to see that picture playing out right now from the West, from the U.S., with what's going on, is particular with the trade negotiations that are taking place. So think strategically when you think about gold and keep that allocation in mind.
Very good. Okay. Strategic mindsets on. And thank you so much for coming on to go over what's happening in gold. This was really informative for me.
It's been great to be here. Thanks, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Joe Cavatoni with the World Gold Council.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.